So, Ed, is there a role for US activism in Europe?
Definitely. There are companies both in the UK and in continental Europe who need to change, whose business models need to be adjusted as we move into a better economic environment. And I think that over time, as the economic environment improves, the winners and losers will begin to emerge. So there's been a lot of rating compression during the downturn, and I think the winners and losers, or the, if you like, the outperformers and the non-performers will become more clear as the economic environment improves. What that means ultimately is that as the tide goes out, a lot of companies are going to be sat there underperforming and thinking, well, okay, we're going to have to change strategy, or we're going to have to amend our strategy in some way. Long-only institutions will undoubtedly see that, and they'll come under pressure from them, and undoubtedly boards will plan for that. But then the activists can come in behind that and perhaps accelerate that change. So I think there is a role. Europe needs a little bit of corporate Europe, I think, needs a bit of shaking up on occasion, particularly continental Europe, where you've got these cross-holdings that have for many years potentially suppressed shareholder value.
What happens if you're a corporate? It might appear to the outside world that you're underperforming, but actually it's not really a problem with the business, and things will pick up, you know, at the end of the cycle. So what should a board do then? What tactics can they deploy to fend off an activist?
Well, the first goal of investor relations, and in particular the CEO and CFO, is to try and help institutions understand the environment in which a business is doing business. If they are struggling for particular structural reasons, they need to make the market aware of that. And if they haven't, and there's an asymmetry between what the board understands to be the business environment that it's acting in and the institution's view of the business environment which the company is acting in, then that needs to be brought together, that needs to be reconciled, because poor investor relations is about poor expectation management. It's about lack of understanding in the institutional community. So one of the things that can protect a business fundamentally against an activist approach is proper understanding of the business and its environment within the shareholder base. They ultimately are the people who are going to protect you from an activist, and so they need to have a proper understanding of what your business is about.
And who should a corporate be engaging with at those long-only funds?
Well, that's an interesting question, because normally the key contact point for the CEO, CFO or investor relations officer will be the portfolio manager. Ultimately, he's the person making the decision about whether they invest more, whether they stay neutral on the stock, or whether they begin to ramp down their investment in the business. That changes in an activist situation where the attack is really, or not the attack, but the debate is about the business itself, maybe the structure of the business, its operating metrics, the decisions it makes around M&A. But in fact, what it normally boils down to is corporate governance. It will be about either the activist wanting to change the management or introduce a non-executive, or maybe even four in a recent case, to the board. So it boils down to, it can boil down to a corporate governance type of fight. Now, in that situation, it's interesting because the decision-making role of the portfolio manager can become significantly diluted or actually removed in its entirety. And it moves to the corporate governance specialist within that fund manager, who ultimately makes, if you like, the fiduciary duty decision around which way that particular fund within that portfolio manager actually controls, how they should vote. Now, there are different styles within different houses. Sometimes that decision is completely removed from the portfolio fund manager. Sometimes it's done in conjunction with. Sometimes the portfolio manager will retain that entire control themselves. But it's interesting that in most activist cases, the investor relations officer will have a very good idea about who the investment decision maker is, but has a less good idea about who the actual voting decision maker is. And that's critical, because if time is short, you don't want to be spending the first 24 to 48 hours of an activist situation scrambling around trying to find out who the decision maker is.
And those first 24 hours, is the process that a US activist and a European activist might might take. Are the processes different? So are those 24 hours different in any way? Or
Well,
is
I
it
guess
pretty much the
it's
same?
the first 24 hours of which part of the process that's important. So the first time that someone turns up on your doorstep and says, "Hi, I'm on your shareholder register. I'm an activist. I want to have a discussion about your company's strategy or governance structures, whatever it happens to be." That can be a very calm period. Okay, and boards can sort of suck the air between their teeth and think, "God, we've got an activist on our books." Alternatively, what they can do is to think, "Okay, how am I going to begin engaging? Might that initial engagement, do they want to be?" So the decisions to be made are: does this individual want to become an insider? And if not, how do we engage without providing them with inside information? Does that mean that we need to start having a debate about non-disclosure agreements? Do we actually know who this individual is? Because remember, most US activists are completely unknown both to the UK corporate community but also the corporate advisory community. So quite often corporate brokers, traditionally the people who have a good understanding of shareholder structures and who individual shareholders are, your traditional UK broker will not even recognise the name of the activist fund that's coming in. They won't know their voting, what their approach is, who their friends are, how other institutions have interacted with their voting, with the activist voting in the past. So there's a whole learning curve to be gone through. And then there's a choreographed sort of dance that companies go through as they begin to interact with those activists. A first call, a second call, potentially a meeting, more informal meeting over dinner, then more interaction, perhaps more information if that's what the activist wants. But spats can break out at any time, particularly around NDAs and this idea of bringing an activist inside. Sometimes they don't want to be. And if an activist says, "I don't want to be brought inside," the board's immediate reaction will be, well, in that case, how long a term investor can this individual be, given that if he's a long-term investor, he shouldn't have any issue with being brought inside. Because they begin to feel that if you don't want to be brought inside, you want the optionality to flip out in the short term. So that's the first piece when you're first aware that the activist has come onto your shareholder register and made contact. The next piece is more difficult, is when suddenly an activist breaks cover and starts interacting publicly and making their arguments publicly through the media or through interacting with your own institutions. Now that period is something that companies undoubtedly need to prepare for, because you're suddenly going to find that you're the focus of media attention. You're going to come under a lot of pressure as to the arguments of an activist often feel compelling to an outside audience, even if in the detail they fail in terms of their argument, but you're suddenly in the centre of a media maelstrom. So how you react in that first 24 hours of, if you like, public awareness that the activist is on board is very, very important. We've seen some interesting cases over the past few years as to how companies have reacted.